Good afternoon, everyone. Thank you so much for joining the Holland Knight tax team to talk about the Superfund tax on chemicals. We're excited that you joined us, and we thought it was a really good time to get back together and talk about this tax, given the flurry of IRS guidance and guidance from the Treasury Department. In particularly, we wanted to talk to you about the notice of proposed rulemaking that was issued recently in March. We have a number of presenters from the Holland Knight tax team with us here today. My name is Nicole Elliott, and I'm joined by my fabulous colleagues, Amish Shah, Daniel Strickland, and Mary Kate Nicholson. All of us have been actively working with clients on the Superfund tax on chemicals. Some of us before it was even reinstated by Congress recently, and working on the Hill to make modifications to the law. Since that time, we've been actively trying to work with Treasury and the IRS on behalf of clients in hopes of receiving favorable guidance, and also working with clients through some of this procedural kind of nitty-gritty as it relates to the Superfund tax on chemicals. Our agenda today is first to really start off giving you a basic overview, just to make sure that we're all on the same page, to talk a little bit about what the Superfund tax on chemicals means and how it's generally imposed. We then want to walk you through all of the recent IRS guidance, again, particularly focused on the notice of proposed rulemaking, as it was a really significant development in this tax. I think in particular because a lot of us either weren't around or don't remember how this tax operated when it was effective back in 1995. This guidance is particularly helpful as it provides a roadmap. Finally, we wanted to talk about the items where Treasury and the IRS have requested guidance on the notice of proposed rulemaking to ensure that your input is heard by those entities. Just a matter of housekeeping, we will be recording this webinar and we will be making the slides available. So you should get an email from our marketing department with both of those things at a later date. If you have questions during the webinar, please just put them in the chat box. We think we're going to be able to answer them live, or at least as we go through the various topics. To the extent that we don't get to a question, or to the extent that the question requires a little more detail back and forth, please feel free to reach out to any of the presenters at a later date, and we can try to answer those questions for you. Without further ado, I'm going to hand it over to my colleague, Amish Shah, to give you, again, just some basic overview of the Superfund tax on chemicals.
Thank you, Nicole. As Nicole said, we're going to start off with just giving you a lay of the land on the Superfund tax. I know that there's some folks on here listening in that have been working through a lot of the details and some of the issues, and others who are really just getting into it more recently. So what we call the Superfund tax is really in 4 provisions of the Internal Revenue Code, 4661 and 4662 for taxable chemicals, and 4671 and 4672 for taxable substances. So it's fairly contained within the code. So one of the reasons, why are we talking about this now? So the Superfund tax was enacted in 1980 as part of CERCLA, but it expired in 1995. So this was reinstated in 2021 as part of the Infrastructure Investment and Jobs Act. So there was a period of about 25 years where we didn't have this, this tax wasn't actually effective, even though it was still in the Internal Revenue Code. And that goes back to Nicole's point of a lot of people who are practicing this, a lot of the folks who practiced in this back in the 90s and back in the 80s are no longer looking at this. And so there are a lot of new questions that are coming up among those who are looking at it now for the first time. So at its core, what this tax does is there are a number of chemicals, 42 chemicals in particular, that are subject to this tax. So they're either subject to the tax because they're in their neat form, because they're combined, not chemically combined, but combined with other substances, or they're chemically combined with other substances. So if they are in their neat form or they're non-chemically bound to another product, we refer to those as taxable chemicals. If they're chemically bound to another substance, we refer to those as taxable substances. And the idea ultimately, at a very high level, and we're going to get into a lot more detail as we go along, is to ensure that a tax is properly imposed on taxable chemicals, whether they're blended with some other material chemically or otherwise. So what this tax does, like some of the other excise taxes that we sometimes work with, is it puts an amount into a particular fund. And here's the Hazardous Substance Response Trust Fund. And that fund is used for cleaning up hazardous waste sites. So, what we have so far is we have the statutes, we've had some sub-regulatory guidance, as Nicole said, we now have proposed regulations under this as well. So we'll start with the statute. So taxable chemicals, so 4661 to 4662. There are 42 chemicals that are identified in the statute, and that's a static list. So Treasury doesn't have the authority to add to that list. And so those are the 42 chemicals unless the Congress makes a change to those. And the tax on those 42 chemicals is it applies to the manufacturers, producers, or importers on the first sale or use of those chemicals. But what can happen there is we can have an import of a substance that contains a chemical that would otherwise avoid tax under 4661 or 4662. And that's really where 4671 to 4672 come in. And so they tax an importer of a substance that has taxable chemical in it. And the threshold, it has to have 20% taxable chemical in it. We'll get into that in more detail. But this is a little bit different in that those taxable substances, there are 50 that are listed in the statute. There's guidance that's provided, and Treasury has the ability to add or subtract from or add additional taxable substances as well. And so there's been some that have been added already, which we'll talk about, and taxpayers can petition to have taxable substances added to or removed from that list.
The other thing I wanted to add, Amish, obviously when Congress reinstated this tax, it was not welcome news to many of you, especially thinking that you had been done with this tax since 1995. I would mention that there is rumblings on Capitol Hill about at least Senator Cruz will be introducing legislation April 18th, later this month, to repeal this tax. I mean, to be seen whether that will work. But, there are certainly some folks on the Hill who do not support the reinstatement of this tax.
And as it currently stands, it does run out through 2031, absent any other change. Okay, so that was a basic, overview of when the tax is imposed. There are a number of exceptions to this tax, and they generally are based on the use of the taxable chemical or the taxable substance. And this is not unlike other excise taxes that are imposed. We see this in the fuels area as well, where when the product is used for certain purposes, it may be exempt from the tax. And so there are a number of, we'll get into further detail, but there are a few, for example, when methane or butane is used as a fuel, when certain taxable substances are used for the production of fertilizer, or when certain of the taxable substances are used in the production of a motor fuel. And those are three of the exceptions that we see most often, but there are a number of other exceptions that we'll talk about as we go further down through the webinar. There are other exceptions: no tax if the chemical is exported, and fractional tons are taxed. And so the tax is imposed on a per ton basis, but to the extent you have a fraction of a ton, there's a tax imposed on that as well. And then the situations we'll talk about where tax has been imposed and paid, but ultimately used for a non-taxable purpose, there's the opportunity for a refund or a credit of that tax.
The other thing I wanted to add here is that, there are exceptions built into the statute. And we say here that they were based on policy. When Congress reinstated this law, they didn't meddle at all. They didn't change any of these exceptions. So as we go through them, if they don't seem to make a lot of sense in terms of policy reasons why to exempt them in 2023, realize that it was based on old law and that none of these were updated. So we sometimes see a disconnect of why did Congress think that that was important in 2023? And the reality is it's just a holdover from old law.
We talk about taxable substances, and so those are the 42 taxable chemicals. Those are the 42 chemicals identified in section 4661. So when we talk about taxable substances, again, the definition of a taxable substance is a substance in which taxable chemicals constitute 20% or more by weight or value. And that was a change from the prior statute where the metric was 50%. So in notice 2021-66, Treasury added to the list of taxable substances that are in the code. So the code has, as I mentioned, 50 taxable substances. Treasury added another 101 taxable substances to that list. So we have 151 taxable substances in total at the moment. The tax that's imposed, and we can, we'll get a little bit more into the formula, but ultimately the tax that's imposed on the taxable substance is a tax that would be imposed under 4661 if the taxable chemical in the taxable substance had been sold in the US. And so the idea here is to avoid the escape of taxation from taxation of a taxable chemical that is within a taxable substance that's imported into the United States. And so when you're looking at how much tax imposed under 4671 on a taxable substance, you determine that by reference to 4661 and the tax on the taxable chemicals that are in the taxable substance. And one thing to point out is that the tax on the taxable chemicals, the tax rate on the taxable chemical varies by taxable chemical. And so in 4671, there's a different tax rate for different taxable chemicals. And as well for taxable substances, the Treasury has provided tax rates for 121 of the 151 taxable substances. But if the taxable substance isn't one of those that's provided for in the notice as to what the taxable rate is, then there's a calculation that needs to be done. And if there's not enough information to make the calculation, then the tax rate is 10% of the appraised value of the taxable substance. So the rate is determined either by what Treasury has already provided to us, by a calculation of looking by reference to 4661, or if that information isn't available, an amount equal to 10% of the appraised value of the taxable substance, which was an increase from the prior iteration of the Superfund tax. So the taxable chemical list of 42 chemicals is a static list. The list of taxable substances is not static. And so right now there are 151 taxable substances. And taxpayers can petition to have substances either added to or removed from that list. And the procedures that are provided for doing that under Rev Proc 2022-26. And so when that happens, when that's added, then on a prospective basis, a substance can be a taxable substance. And so this is an academic exercise. This is not an academic exercise. This is actually happening. We have petitions that are pending for certain taxable substances to be added to the list. Those are the taxable substances at the bottom of this slide. I am not going to try and pronounce some of those because I will mangle those for sure. But it's important, but the key takeaway on this is it's important to be staying on top of these petitions, because there may be instances where it affects you, it affects your suppliers, and affects other counterparties that you deal with. And if a tax is imposed on a taxable substance that's in your business, ultimately it could flow down to your business, and it's important to think about weighing in on a pending petition.
And all of those, I would say, are posted in the Federal Register. It is a requirement that those petitions, notice of those petitions go in there, and that is the mechanism by which the public is made aware and can provide comments.
And the one thing I'll add here is that we're seeing a lot of companies who deal in taxable chemicals and substances modifying their contracts to include mention for if the Superfund tax applies. So, we're doing a lot of advising on that aspect of these businesses as well.
No, great points. So getting down to a little bit of nuts and bolts of how we pay this tax. So the tax is reported on a 6627, Form 6627, and that rolls up into a Form 720. And so, a number of you on the call regularly file Form 720s, and so this rolls up into your quarterly 720. This is a quarterly excise tax form. And like with a lot of excise taxes, there are deposits due. So the payment isn't just made at the end of each quarter, it's made with deposits. And so those deposits are due twice a month, 15th of each month and the end of the month. And so the question that's come up and came up particularly when the Superfund tax was reinstated is, how much of a deposit do I need to make to avoid penalties? And so, there's been some relief provided for that because, companies aren't sure exactly what's taxable, and there wasn't a great deal of time to create the systems within companies to determine the amount of tax that would be due and determine the amount of deposits that would need to be done. I mean, it takes, as many of you know, a lot of work to internal computer systems and otherwise. So, the IRS has provided relief, and they recently extended that relief so that if you make deposits and your deposits are a little bit off from what they should be, there would nonetheless not be failure to deposit penalties. The other important part of that is there's a safe harbor in the rules, and the safe harbor says that you can make semi-monthly deposits that look back 2 quarters, and you look back 2 quarters, you look to see what was your tax for that quarter, and you pay in each deposit 1/6 of that tax amount. And that's an easy way and a good safe harbor in order to make sure that you are making the correct amount of semi-monthly deposits. And it's important to have that ability to do that, but you lose the ability if you fail to make proper deposits on time. So, short of this is 2 points. One is we're going to need to make sure we're making semi-monthly deposits for this tax. And at the moment, there's some relief about calculation of those deposits. That relief expires, later this year. And once that expires, we need to be more careful about ensuring that the semi-monthly deposit is the appropriate amount.
So I was going to just jump in and cover the proposed regulations. So in addition to the notices and the Rev Procs that Amish was talking about, in late March, the U.S. Department of Treasury and the IRS issued proposed rules, proposed regulations. You may even hear some of the presenters refer to it as the NPRM, the Notice of Proposed Rulemaking. And these are just that, they are proposed. What that means for those of you who aren't familiar is that now that they are proposed, the public, stakeholders, anyone has the opportunity to submit a comment letter. Those comment letters are public, and we have 60 days to do so. The Treasury Department and the IRS are then required to consider the comments received from stakeholders and finally promulgate final regulations that have the full force of law. In the interim, however, taxpayers are allowed to rely on the proposed regulations that were issued in March, so long as they rely on them in full. So as a taxpayer, you can't pick out the rules that you like and disregard the others. You've got to accept it wholesale if you want to rely on the proposed regulations. I think on the whole, the contents of the proposed regulations were not particularly earth-shattering. It was very helpful guidance, maybe not everything that we wanted, or it didn't fall the way that we wanted, but they did highlight a lot of kind of important fundamentals. For example, the definitional terms, we'll talk about those in a minute, what it means to be a manufacturer, thus potentially subject to this tax. As Amish mentioned, the taxable chemicals are 42 static, and helpfully the proposed regulations provided us for the first time ever, to my knowledge, the molecular formula to those taxable chemicals. So that's a helpful detail for many of us. And then it talks a lot about the kind of procedural rules those policy exceptions that we were talking about, what they mean, how to claim them, if someone's paid the tax, how to get a refund. So again, kind of really practical regulations, not always what we wanted, but provides really, I think, a good roadmap to ensure that we are being compliant with the Superfund tax on chemicals.
And I think one of the things we appreciate about it, and we'll go through some of these as we go through this, is it provides a number of examples. And we often find examples to be very helpful in ensuring compliance with proposed regulations or other guidance. And so there are a number of very helpful examples, and we'll walk through a few of those as we go through this, the materials. But it is helpful for those who are looking to comply to read through some of those examples.
So fundamentally, the Superfund tax, as it relates to taxable chemicals, is a tax on the manufacturer, producer, or importer. The NPRM, the proposed rules, gave us a definition of who those taxpayers are. Who is the taxpayer potentially subject to the tax? I would say throughout this package, or throughout the proposed rules, the definitions are pretty expansive. And we see that manifested here when we talk about who is a manufacturer or who is a importer. A manufacturer under the proposed rules is basically anyone who produces a taxable chemical, whether that's through raw materials, through mining, through manipulation of a substance. The only exception that was called out in the proposed rules as a person not being a manufacturer of taxable chemicals is someone who is a contract manufacturer. That is someone who, subject to a contract, is manufacturing a taxable chemical at the behest of another. And in that case, the person with whom they're doing that business for would be considered the manufacturer. So again, a very broad definition of manufacturer or producer. Similarly, importer is defined fairly broadly. It's any person entering the taxable chemical for consumption, use, or warehousing. Few narrow exceptions. One is an agent or customs broker. So again, someone doing something at the behest of another is not an importer. And then there's a special rule for drop ship businesses. If you're in the United States, you would be considered an importer under these proposed rules. If you are foreign drop ship business, you would not be. So again, broad definitions with some narrow exceptions, but that is under the taxable chemicals list. Who is the taxpayer?
Nicole, I do want to add to that the IRS has given us a definition of person in this context that includes disregarded entities. So it's similar to the definition that applies with respect to your 720 filings, as opposed to the IRS's general definition of person that would exclude your disregarded entities.
So the manufacturer, producer, importer are the taxpayer. But we also need to talk about when the tax attaches. It is actually possible to be a manufacturer of a taxable chemical and not be subject to the tax because you haven't triggered it. That is, there is no attachment point. The attachment point under the Superfund tax on chemicals, as it relates to taxable chemicals, the 42, is when you sell or use it. That is the triggering of the tax. Not surprisingly, the proposed rules define these terms, again, very broadly. Sale, I don't think we really had, I didn't come across any clients who had questions about whether they had a sale, but it was a transfer of title for consideration. But there were a lot of questions around, did I use the taxable chemical, thus triggering the tax? And what the proposed regulations do is basically include anything that you do to that taxable chemical is a use. It triggers the tax. And that includes when it's consumed, when it functions as a catalyst. Basically, whenever its chemical composition changes, that is a use of that taxable chemical. When it's used in the production of a chemical mixture. So even though, and I should say chemical mixture is defined in these proposed rules as solutions like suspensions, where you're not changing the chemical makeup of the taxable chemical, but simply by putting that taxable chemical in a chemical mixture, you are using and thus triggering the tax. Or any other thing that's considered use is when you're putting that taxable chemical into service in the trade or business to produce income. So again, very broad definitions. I don't think that many sort of surprises here. They did carve out a couple things that I wanted to mention that aren't considered uses. And this was true under the old Superfund tax. So if a taxable chemical gets spilled, fire, or natural degradation, that you're not using that taxable chemical. There's no use there. And the interesting thing, I think the one interesting thing that the proposed rules do is that they say, fundamentally what they're trying to do, and I don't know that they're always successful in accomplishing this, is saying Congress designed this law to tax a taxable chemical once. There shouldn't be multiple people paying tax on the same thing. And so the way that the proposed rules address this kind of fundamental principle of taxation once is to say, while you're using a taxable chemical, if you're making a chemical mixture, you're putting in a solution. But if you're just then diluting as a second step, for example, that chemical mixture, it's not a second use. So to avoid this concept of should be double, it can't be double taxed.
And Nicole, I think that, just on that second bullet, you'll see as we walk through some more of the exceptions and applying those exceptions that the rules kind of adhere to that basic principle of trying to only tax once. And so you'll see that when a tax paid chemical is used and then used again, there are efforts made in the rules to ensure that that tax paid chemical is not taxed again.
Yes. There are also under the taxable chemicals some certain rules that around foreign manufacturers, right? Because what Congress is ultimately trying to do with this tax, I think, and what the IRS and Treasury are trying to do is create this level playing field between whether the taxable chemical was produced here in the United States or in a foreign country. And so they've spent some ink on these proposed rules, going through kind of the special situations. So when a foreign manufacturer sells it to an importer, the tax still rests on that importer, the person who is considered that importer. And we went through in a previous slide who that is. When the chemical mixture, this is probably a little down into the weeds, but what Treasury and IRS, I think, are a little concerned about is someone importing, rather than importing a taxable chemical, which would be subject to the tax under the basic principles of the Superfund tax on chemicals, importing a chemical mixture. So something that contains a taxable chemical, where the taxable chemical, again, inside that mixture still retains its chemical composition. And in the proposed rulemaking, it includes that importation of a chemical mixture. Now, a lot of these will be caught up probably in the taxable substances list that Daniel and Mary Kate will talk about, but it does try to kind of close a loophole, so to speak. If there is something coming into the United States that's not listed on the taxable substance list, but contains a taxable chemical, Treasury and IRS assert the ability to collect a tax on that chemical mixture. Interestingly, what they do also say is that if there is if there's a compound that comes in where a taxable chemical was used to make the compound, but doesn't exist in the compound, we don't have authority to tax that compound. So it's a little difference between a chemical mixture and a chemical compound. But Treasury notes this and is seeking comment on this, in fact, and there are several places where we'll try to point out where Treasury and IRS are seeking comment on the proposed rules. But this is one area where they are clearly trying to level the playing field. And then in the bottom of this slide, for those of you, there are a couple special rules, and those come from when taxable chemicals, they are realistic in that some taxable chemicals come from ores, or some taxable chemical, one taxable chemical in particular is an actual ore. So the proposed rules kind of address who is the taxpayer and when that tax attaches. So you've figured out your taxpayer, and you've figured out you've got a taxable chemical, one of the 42 on your hands, and the tax has been triggered. The next obvious question is, okay, how much tax do I owe? And under law, that is just the tax is the tonnage times the tax rate, and the tax rate of the taxable chemicals is in the statute. IRS and Treasury have no authority over that. And unfortunately, when this tax came back to life recently, the tax rates were doubled across the board. There was not a single taxable chemical that came off that list of 42 or that was added by Congress in this recent iteration. And all they did with respect to the rates is that they doubled them. There was no other more minute kind of changes. The proposed rules talk to us a little bit about how conversions, how fractional tons have to be included, how in a chemical mixture, you've got to get the weight of the taxable chemical in there to figure out your tax, and how to convert the tax rate when you're not doing it by weight, but you're considering volume. And that is, again, one area where the IRS is and Treasury are accepting comments to get it right. In the bottom of this slide, just very quickly, we just provide an example. When you're importing a taxable chemical mixture, you've got to really look at what taxable chemical is in that mixture and do the math to figure out what your tax liability would be. And I think with that, I'm turning it over to Mary Kate.
Thanks, Nicole. So probably what a lot of people are interested in is how that you can avoid paying the tax. As Amish and Nicole both alluded to earlier, there are several exceptions, some that don't really make sense now in 2023, but we have them, so might as well take advantage of them if we can. So there are 7 exceptions from the tax. We're going to dive more heavily into the first 2 and the last 2 on this list. But I did just want to mention that the IRS specifically is asking for comments on several of these exceptions to the tax. Specifically, they're asking for comments on, what does it mean for this 4th exception? What does air pollution control equipment entail? So if you are interested, and if you do think that you will be utilizing one of these exceptions, just pay special attention to the preamble and the proposed regulations discussing those exceptions to see if you want to comment on the exceptions. All right, so our first exception is a qualified fuel use. So under this exception, methane or butane is a taxable chemical only if it is used other than as a fuel. So kind of have a double negative here, or other than in the manufacture or production of any motor fuel, diesel fuel, aviation fuel, jet fuel, which we'll get to that one in a bit. So other than a fuel means used other than in the production of energy. And if you are not exempt, if you do not qualify under the qualified fuel use exemption, then you are treated as the manufacturer or producer of the taxable chemical. This is and what they define qualified fuel use is consistent with Notice 2006-92 and the fuel tax regulations, or the alternative fuel tax credit regulations underneath those as well. So just a quick example. So company X, produces methane and sells it to company Y. So in this case, you can see that methane is one of the taxable chemicals that is exempt from the tax if it is used as a fuel. So in this case, methane is used in the production of antifreeze. Therefore, the entity that uses the methane in the production of antifreeze, which is not for use as a fuel, not used in the production of energy, they're going to be the ones liable for the tax. And so when you're really thinking about these exceptions, one of the things that is important is to try to identify, in the chain of command, the chain of custody of that taxable chemical when the first non-exempt use occurred. And a lot of times with these exceptions, you are able to give an exemption certificate to the seller, say that, hey, I'm using this for an exempt use. I should not be liable for this tax. But in many times, the chemical has already been sold 1, 2, or 3 times. And so the tax might have already been paid. So in those circumstances, a refund or credit will have to be obtained, which we'll get to in just a second. The second main exception is qualified fertilizer use. So under this exception, the tax is not imposed if certain chemicals are used to produce ammonia, that is a qualified fertilizer substance. And you'll start noticing a pattern with these exceptions, in that, again, here, the first person that sells or uses the chemicals for other than as a qualified fertilizer substance is treated as the manufacturer of that chemical. And helpfully, the proposed regulations clarified that this exception is available for multiple intervening sales, so not just a resale one time. And they do provide a blanket exemption certificate for up to 1 year for the qualified fertilizer use exception. So if you're in this field, again, really advise you to take a look at those proposed regulations and the preamble, because this is an area where I think the IRS really did come back and provide a lot of helpful guidance to taxpayers for this specific exception. The third exception is for use as a motor fuel, a little bit different than the use as a fuel that we talked about earlier. So under this exception, the statute kind of identifies what the notice of proposed rulemaking refers to as fuel chemicals. And these are chemicals that are tax-free if used in a qualified fuel substance, which either means is used in a qualified fuel use. So we have another definition we have to track down: sold for use by a purchaser in a qualified fuel use, or sold for resale for ultimate use at a qualified fuel use, which basically means as long as eventually that substance is going to be, or that chemical is going to be used in the manufacture or production of motor fuel, diesel fuel, aviation fuel, jet fuel, or any fuel chemical, then it is exempt from the tax. Again, just like with the use as a fuel exception and with the fertilizer use exception, the first person to use these substances other than as a qualified fuel substance is treated as the manufacturer of the chemical. And then, as Nicole talked about, the manufacturer, that is where the tax attaches. Here, the tax is calculated based on the weight of the fuel chemical sold or used to produce the derivative fuel substance that then becomes the fuel use. And like I talked about earlier, here it'd be great if when, the producer of the fuel in the qualified fuel use knew that, when they purchased that, the seller knew that person was going to go use it for a qualified exempt purpose. And that's what you have. There are model exemption certificates available in the proposed regulations that you would be able to show the seller. But a lot of times we unfortunately do not have, you don't know, the first seller doesn't know that, for example, xylene is going to be used as a motor fuel and exempt from the tax. So in those circumstances, you would want to go back and get a refund or a credit for the tax. And then our last exception that we're going to talk about is the most complicated exception. But I think, we're already talking about taxable chemicals and substances and molecular formulas here, so why not just continue the fun? So here, no tax is imposed on any organic taxable chemical while such chemical is a part of an intermediate hydrocarbon stream. containing one or more organic taxable chemicals. And again, here, those organic taxable chemicals are all listed out. So methane and butane are not considered an organic taxable chemical here, because at the time of isolation, which is where the tax attaches that we're going to get into in the hydrocarbon streams, methane and butane are not considered taxable at that time. So that's kind of why if you're expecting to see methane and butane here, they're not in this list. So when would the tax attach in this instance? So there has to be an isolation in order for the tax to attach to one of these organic taxable chemicals. So if no tax was previously imposed on one of these organic taxable chemicals, and the chemical is eventually isolated, then that isolation is from the intermediate hydrocarbon stream. That isolation is treated as a use by the person causing the isolation, which, as Nicole talked about earlier, the use is what triggers the tax. And then the person that is treated as a manufacturer, which means the tax attaches to the manufacturer, and that manufacturer is liable for the tax on the chemical isolated. If there is a multi-step isolation, the person that first uses the chemical to isolate is treated as the manufacturer, and that person owes the tax. So I know probably what I just said makes zero sense. So it's definitely most helpful to walk through this with an example. I'm still not even sure what a hydrocarbon stream is, but I'm sure that many of you do who are dealing in this space. So a helpful example, and this is right out of the proposed regulations. So if you want to see it in more of a just plain word form, you can find that there. So in this example, it's an example of a refiner of petroleum products. And so we're starting out with gas, oil, and fluid catalyst to start. And so you see in this first box that we have a fluid catalytic cracking process that produces lighter chemicals, including liquid petroleum gas. Then the producer uses a fractioning process. And throughout this entire time, the chemical is still part of an intermediate hydrocarbon stream and therefore is not isolated and is not taxed. Then the fractioning process, you have a separate stream of C3 and C4 molecules. Then the taxpayer uses a splitting process to produce refinery grade propylene, who then sells that to a purchaser who further refines. So in this example, the splitting process is what causes the isolation of the organic taxable chemical, in this case, propylene, and that is where the tax attaches, and that is considered the use that triggers the tax. So in order to take advantage of this exception, a G registration is required. And so with that said, I'm going to turn it over to Daniel, who is the expert on all things registrations.
Thanks, Mary Kate. Yeah, so for all of these exceptions that we've talked about so far, the proposed regs require a certificate in one form or another, and we'll talk about some of the other ones in a minute. For intermediate hydrocarbon streams and for inventory exchange, what's called a G registration is also required. Process is fairly straightforward. You apply to the IRS using a form 637 for an activity G registration. So in this circumstance, if you apply for a G registration and are accepted, then you'll use your registration, and also for inventory exchanges, a -3 certificate that's in the proposed regulations. And for intermediate hydrocarbon streams that Mary Kate just talked about, you'd use the model certificate from the -2 regulation. But I do want to point out that the registration process is new. It's been in existence for other excise taxes for a while. The G registration is new, and so the agents are seeing this fresh, just like you are. the speed of the process and the ease of the process is really going to be affected by how well the application materials communicate what you're doing. And, we talk to a lot of folks about that process and try to help walk through it with you. Mary Kate, if we could go to the next slide for tax-free sales. So for all these exceptions that we've been talking about under 4662B, you have to have a certificate. And so this is an unexpired exemption certificate from the purchaser, and you can take a look at the -2 regulations to see that model exemption certificate. And then you also have to have no reason to believe that what your purchaser is giving you, the information is false. Sort of a safe harbor, good faith effort, if you will. For the sake of time, I'm just going to keep walking through here so we can get to some of our better examples. Catherine, you asked a question earlier about taking a tax paid chemical and using it to produce something else. This example is similar to your question, but not exactly. So where you've got a 4661 tax that you've paid for a taxable chemical, and the chemical gets used by a subsequent manufacturer to produce some other taxable chemical or taxable substance, and that's sort of where your example differs. But the credit or refund process for the subsequent manufacturer requires the tax to be paid, requires the subsequent manufacturer to use that tax paid chemical to manufacture another taxable chemical or substance. Then the taxable chemical or substance gets sold or used by the subsequent manufacturer, and the timely refund gets claimed. Plus, you have to have one of these model certificates. So let me go through a quick example, and this is taken from the example 1 in the proposed regulations. This is just half of that example. So in this scenario, X manufactures 3 tons of taxable chemical and sells it to Y. So X pays the tax at $9.74 a ton on all 3 tons. So the government is made whole at this point with respect to the tax on chemical 1. Y uses 2 of those tons of chemical 1 plus some other stuff to produce taxable chemical 2, which is taxed at a lower rate. Through the refund process, the credit process that we just talked about, the tax that was paid for chemical 1 offsets the tax that would otherwise be owed by Y when Y sells the produced chemical 2 to Z. One thing that jumped out at me when I first read through this example was that the difference is about $3 of tax that was paid by X on those 2 tons of taxable chemical 1. Those $3 are not refundable. They stay in the Superfund. So the other third of the tax that had been paid on chemical 1 can be used by Y to offset a later produced chemical or substance to the extent it's taxable as well. So the next slide goes through refunds for exempt uses. So use as a fuel, use as a fertilizer. So taxes paid that exceed the amount of tax that's determined for the exception are allowed as credit or overpayment to the person using the fuel chemical as a qualified fuel substance. Similarly, in the fertilizer context, it can be used as a credit or overpayment if you're using the chemical as a qualified fertilizer substance. With that, I'm going to turn it over to
Take it from here.
Amish for exports. Hopefully I've saved you enough time.
We're good. So, one of the themes that we've talked about here throughout the presentation is the goal of taxing the taxable chemical once, whether it's in a taxable chemical form or a taxable substance form, and either treating the sale as a non-taxable sale or allowing for a refund of the tax. And so, one of the things that the proposed regulations provide are some of the rules around refunds of the tax and what information is needed and how to get a refund of the tax. And so one of the themes, again, is to try and make sure that that single tax and it's on tax on products that are really used in the US. And so there is you can do tax-free sales or get refunds where the product the taxable chemical is exported. And so the question really is, when can you do a tax-free sale for an export versus when is it a taxable sale that someone can then go back and get a refund of the tax? And obviously the former is preferred, but it's only allowed in certain circumstances. So what the proposed rules provide is that if the manufacturer sells to a first purchaser, and the intent is that that first purchaser will either export it themselves or sell it to a second purchaser for export, then the sale can be made tax-free. And I'm going to distinguish that from the bottom scenario. In the bottom scenario, if the third person in line is the one that's going to do the exporting, so there's a sale from the manufacturer to the first purchaser, then to the second purchaser, and it's the third purchaser that ends up exporting it. That's a taxable sale, but then there's an opportunity to get the refund of the tax paid on the export. So on the first circumstance where there's no taxable tax paid on the sale from the get-go, it really is a question of making sure that's documented and evidenced properly. And so the regulations walk through some of the information that needs to be required, and effectively evidence of export and certification by, if it's the counterparty, of the fact that it's going to be exported. And so, from the perspective of a manufacturer, there is language that is, certainly in the proposed regulations regarding the information that's needed for a tax-free sale. But this is no different than other situations we see in the excise tax world, or even more broadly in the tax world, which is, making sure that you have both the evidence that's required in the proposed regulations, and there's generally making sure you have enough evidence to support the fact that the sale is made tax-free, and that ultimately there is an export or was an export of the product. If we contrast that with the second situation, the question is who's entitled to the refund. So the general rule is the manufacturer is entitled to the refund. We can actually move to the next slide, Mary Kate. So the general rule is we've got a situation where the chemical is exported, and so there's an opportunity for a refund. And so the general rule is a manufacturer who actually paid the tax to the government is the one that's entitled to the refund. And to do that, they need to prove that they repaid the tax to the exporter. Alternatively, the exporter can be the one who is the one who gets the refund, as long as there's a consent to do so. So in any event, here you have a situation where a manufacturer actually paid the tax to the government, an exporter paid the tax on a pass-through basis. Either party may be entitled to the refund, and so coordination is required to make sure that the proper party is the one that's getting the refund, so that ultimately no tax is paid. Okay, so for taxable substances, we've spent a lot of time talking about taxable chemicals. Again, we come back to taxable substances here. And it's the importers we talked about who's liable for the tax on the taxable substance. Again, that's because if the taxable substance was created in the US, then the taxable chemical that's in that taxable substance would have been taxed or should have been taxed under 4661. The tax doesn't attach when there's a sale outside of the US of a taxable chemical. It attaches at the time the importer first sells or uses a taxable substance in the US. And again, the key here is how much is the tax? And the reference point for determining how much of the tax is a look back to 4661. So it's a question of how much tax would be imposed under 4661 on the chemicals that were used as materials in the manufacture of the taxable substance, if the taxable chemicals are sold in the US. And we talked before, and we won't get back into how that's determined. But again, in some circumstances, the tax is provided for in 4661. In other circumstances, the tax ultimately is zero under 4661. And so just an example of how the tax is computed here. So we have an importer here who sells a taxable substance. It's a taxable substance that's actually statutorily described in 4672. And it includes certain chemicals that are taxable chemicals. So, and so what we look for is the weight. So here with 90% of the materials used to produce the taxable substance, we assume the weight's 5 tons. And so ultimately the calculation is based on the tons of the taxable chemical in the taxable substance multiplied by the rate of tax that's imposed by 4661, the taxable chemical provision, to determine the amount of the tax. So what you're really doing here is you're trying to figure out, what proportion of the taxable substance is the taxable chemical, and then imposing the rate for that taxable chemical that's provided for 4661 to determine the amount of the tax. Again, for many of these taxable substances, the rate is already provided for by Treasury, but in other circumstances, a calculation will need to be undertaken. As you said, there's no, we talked about under taxable chemicals that there's no tax imposed on the sale of taxable chemicals for certain purposes, including fuel use, fertilizer use, and animal feed use. And so the same rule applies under 4671. So there's a cross-reference in 4671 back to the exceptions under 4661. And so what the proposed regulations did was provide some, clarification. I think it's a question as to whether or not really needed clarification, but helpful clarification that the exceptions that apply under 4661 for fuel use, for fertilizer use, and animal feed use ultimately also apply for purposes of 4671 and the taxable substance rules, so that you can avail yourself of those exemptions that are in the taxable chemical rules on the sale of taxable substances that contain taxable chemicals for which there's an exemption. This may be you, Nicole. I think this may be me. Okay, so if the tax was paid under 4671 with respect to a taxable substance, again, these are similar to the rules that we have for taxable chemicals. If there's a tax that was paid that didn't need to be paid, there's an opportunity to get a credit or refund of that tax. Again, going along with the theme of ensuring that products are taxed only once, and that there's a refund available if there's an exempt purpose. Cool.
Yeah, so as we mentioned at the outset, obviously a very significant development was the issuance of these proposed rules by the U.S. Department of Treasury and the IRS. Everything is subject and open to comment. So if going through this webinar, you have comments that you want to make to the U.S. Department of Treasury and IRS, you should absolutely feel free to do so. They are tax attorneys. They are not necessarily those with a lot of experience in your industries. And so I think they welcome and it helps them come up with better rules to the extent you're seeing things that don't quite work or you want to advocate for a different position. There are certain areas in these proposed rules that they specifically sought out comment, and I put some of those up on the slide. But again, everything is open to comment. Just make sure that you get those in by May 30th, 2023. In just a month and a half, we have the public comments. And again, they will have to consider those comments and issue final regulations after that process is complete. I think we are about out of time. I do see some good questions that we are capturing and we will respond individually to those questions. We were able to do some of them live through the chat. And those that are popping up now, we will capture and we will respond to you individually via email. And again, if you didn't get the opportunity to ask a question and you have a question, please, if you go to the next slide, please reach out to any of us. We are all on the tax team at Holland Knight and available to answer questions that may have come to mind as you went through this presentation. Thank you very much. I hope you found it informative, and we hope to be in touch.